Hello everyone, I'm Mark Boyer and welcome to the Boyer Brief. I'm here with Jason Jacoby and welcome to March Madness, right?
Yeah.
We thought it was a basketball tournament, little did we know it's more of a stock market and international catastrophe of war in Ukraine and Russia. It's been kind of crazy, right? So hearing from a lot of you and know that there's a lot of emotion out there. We totally get it. And we're here to help you walk through that and make sure that with our investments, we're doing the best we can. And so wanted to give you some good news, although in the middle of that, we're going to talk some more specifics. But this chart here shows when the S&P 500 since 1980, when it hits what's called a correction, which is 10% below its most recent high, that there's a really good chance over the next 12 months, even to 2 years, that you're going to have a really nice rally off of that. This chart shows the correction return that averages about 12.1%. We hit that this week on the S&P, roughly right around that same amount. And then it shows 1 year later, the opportunity and the potential of a return. That's been roughly 22% almost return off of the lows. And that's happened almost 92% of the time.
Yeah.
Okay, so chances are very good based on just history that we could be decently higher over the next 12 months. And then over 2 years, even higher, 36% on average. So anyway, all that to say is there's no guarantees in any of that, but just understand that when markets sell off, it provides opportunities. And many times, even when it doesn't feel good, you can really make some money and get some returns over the next year or two. So it's really positive. So what are we dealing with, right? Let's talk about some specifics. Inflation has been one of those things. Here's a chart. Jason, walk us through what this chart looks like.
Yeah, so we've been dealing with inflation coming out of March 2020, right? Inflation's been increasing a little bit. You can go back to the 80s and see record inflation and high Fed funds rates, okay? We don't think it's gonna get back to being that high, but we do expect...
Not like this back in the 80s?
Not like that, but with inflation spiking, up 7.9%, our most recent reading in February. March is probably gonna be above 8% that we're gonna see. But with that being said, Jerome Powell and the Fed think, hey, it's time to raise interest rates. It was gonna be about 50 basis points before in our first rate hike in March. More looking like 25 basis points now. But we're hoping to see inflation kind of taper down, not because of what's going on geopolitically, but more the supply chain issue that we've been talking about the last few months. Should see that easing going into the end of 2022 into 2023. So hopefully we should see inflation start to tick down. Historically, over the last 90 years or so, it's been about 4% year over year, which is high comparative to what it's been, since the mid-2000s?
Yeah, 2%. We've been recently about 2%, which has been the Fed's goal, is to try to hold it there. But ironically, over that longer period of time, it's been 4%. So not surprised that we get higher inflation in here. And the other thing is over that same 90 years, stocks have averaged about 10% over that period of time. So again, key thing with inflation is we need to outpace it longer term, so that our purchasing power gets us more services, more products, those types of things. So we have to outpace inflation. So stocks are a good way to do that. But anyway, that's something that we're dealing with is inflation. The other thing is looking at this is, part of that inflation, right, is one aspect. You have supply chain issues and all those things that we've been dealing with, and we see that working itself through. But the one that's painful right now is the oil, right? I mean, it's what's happening with the war. U.S. kind of reducing some of their drilling and some of the things that we're doing, and then being dependent again on some of these other places like Russia. And so we've seen this spike in the oil prices since Russia hit Ukraine. They're calling it the Putin effect or whatever. And but the reality is that Russia, you'll see here, represents about 11% of the imports. Crude oil exports by country has been it's been about 11%. So there's lots of people, lots of countries, including the U.S., that is bringing oil to them open markets. But 11% of that is coming from Russia. So anyway, all that to say is that we're not sure exactly where that oil thing goes, or the prices go, but we do know that it could change at any minute if you get some treaty signed or something happens there with Russia and Ukraine. So opportunities, and we've had exposure actually in the portfolios to oil stocks, and that's been a really upside for us. So know that for most part, you guys have all had some investment in those areas, and that's been great. 2 years ago, not so good. But
Right.
we bought some in there, and I know Capital Group and so forth has been adding into those, and now we're benefiting from that in the portfolios.
Absolutely. So rolling from gas into effects on the U.S. economy, like you were talking about, Russia, Ukraine, it's horrible what's going on over there. Our thoughts and prayers are with the Ukrainian people, and we want to get that solved as quick as possible.
Yeah.
But what is the effect on that conflict going over there on the U.S. economy? I know we'll get into sectors in a second, but more of imports. What does that look like?
So this little chart just shows basically Russian imports into the U.S. as a percentage of our imports, and you'll see that we're less than 1%. Rwanda, less than 1% of Russia, is not a big factor for us. So all that said is that we're seeing sanctions, all these things happening. Just know that U.S. is not exposed very much at all to the U.S. As far as our imports to the Russian economy. So that's I think it's an important thing to know.
Absolutely. Okay. Yeah. Speaking of international, there are some sectors that are more exposed to the conflict that's going on over there. We're already talking about a German recession. It's looking likely over there. Yeah. Europe as a whole, because they rely, I think 75% of their energy comes from, whether it's natural gas or gasoline and oil, comes from Russia.
Yeah.
So
we've had sell-off in Europe. European different countries are really struggling worse than we are in our stock market. But just want to say we're looking for that. I think that's going to provide a real opportunity in here. That'll get oversold, and so I think those will be places that, especially as the dollar's been going up in value, if it just starts to pull off a little bit, that helps our international stock. So that's a little plug for our future. Right now, not so great. Emerging markets are hanging in there pretty well, but I think longer term that could be a great investment. But this shows just basically of the S&P 500, the exposure of different sectors to the S&P 500 and to the European economy. This shows here tech, almost 60% exposure to Europe, right? Yeah. So tech's everywhere. Tech companies are selling lots. So that's one of the reasons probably the NASDAQ is. There's a many reasons, but one of them is that because of their exposure to the European economy, some of those stocks are getting sold off harder than others. So that's an issue. And then it's interesting on the other side, utilities has very little exposure to Europe, and that's why a lot of those stocks have rallied in here, plus the dividends that come with utilities. So anyway, this changes year to year, and right now that's kind of the thing that I just want to point out. In more aggressive portfolios, our tech, that's one of the issues for the tech companies is the European exposure.
And which we're buying for those more aggressive portfolios. It's always a good opportunity when things go on discount, instead of running out of the store, to actually get in there and get some good companies at discounts. There's a lot of good companies out there that are trading at extreme discounts or a little bit of a discount. So.
Yeah, I mean, one of the reasons we go aggressive, right, is so that it's time frame. It goes up higher when it's going high, and then it drops more when it drops. But longer term, you get higher returns in the more aggressive portfolio. So again, got to hang in there. If you've got that plan, if we've got a long time frame, there's a great chance an opportunity to be adding to those positions, which we're trying to do is in here as well. So real important.
Awesome.
Great. Hang in there, long term.
Any closing remarks to give to our wonderful watchers here?
Yeah, I mean, again, our prayers and our thoughts and prayers are with the Ukrainian people and all that's going on there. There's a lot of noise out there in the world. Yeah. Again, good solid investing is having a plan, diversification, trying not to watch all those things and just sticking with it, and letting it play itself out. The emotions, and we say this almost every month, emotions can get in your way and be your biggest hindrance to your performance over time. So we feel like sometimes we're counselors, we're like, risk assessments, all this stuff, but that's really important because that's part of what we do, is to help you get to your long-term goals. And we have a plan, we got to stick with it. Absolutely. So we'll make slight adjustments, but also don't ever bail out. Stick in. So.
All right, well, thanks so much. For Mark Boyer, I'm Jason Jacoby. We'll see you next month.